He also worked at the Bank for International Settlements and Clearers. He co-authored Quantitative Equity Portfolio Management in 2006. He received his BA from UC Berkeley and his PhD from MIT. He's an avid musician who's written several pieces and recorded them. And he's also written a screenplay and helps produce a movie with it. So, please, help me give a warm Richmond welcome. Ludwig B.
Thank you very much, Richard. And thanks for inviting me, and thanks for coming out today and giving me a warm welcome. I actually used to live in Virginia, so I'm not too foreign to these lands. At Richmond, I came a couple times to golf tournaments. At Willow Oaks, I think it's they throw like the annual, there's a Virginia Open, State Open, and things like that. So I've been here a couple times. I also wanted to say that afterwards, if you want to come up and talk or have questions, please do so. And also, even afterwards, if you want to email me and keep correspondence, please do so. Also, if you want to ask questions at any point, just do so. Because I was informed that we have about 30 minutes, and I prepared more than 30 minutes, so I'm going to have to cut it and figure out what you're really interested in, and that may be a little bit of a challenge. So I've written this book, and it's called The Crisis of Crowding. And I have to say, I really enjoyed writing the book. Now, why did I write the book? I wrote the book partly because I felt that a lot of the descriptions in the press and elsewhere about the financial crisis of 2008 were misguided. And one of the first attacks was this frenzy to regulate. And so it reminded me of LTCM. When LTCM went down, there was a book out, and there were a couple things that kind of simplified what happened, and everyone kind of forgot about it. And so I really thought I should write something about this. So the book starts in 1998 with long-term capital. And it sort of tells what I believe is the right story about long-term capital. And throughout the writing of the book, I interviewed everyone, John Merriweather, CEOs of all the major banks, some that didn't allow me to thank them because they wanted to be anonymous, some who were fine with me thanking them. And I have to say, I had a really fun time. And if you have any questions about some of the stories of those interviews, which are not in the book, there were so many fun things that happened that I didn't put in the book, just let me know. And I may throw a couple out today. So the title of the book has to do with crowding. And what is crowding? Crowding is this idea that multiple market participants find an interesting trade and they follow that trade. And all of our risk models pretty much ignore the dynamics of the multiple players in the space. And so what happens is the risk return that we believe the space has is completely flawed. And later it leads to catastrophe, especially when you're levered. So that's the idea. The distinction with crowding and other forms of herding and other kind of financial situations is that the holders matter. It matters who's in the space and what their risk return profile is. So it's not just that we look at a space and say, okay, here's a trading space and everyone's gone along this. No, it matters how the people trade the space and the institutions trade the space. And I'll explain that more as we go through. And of course, the biggest problem is that risk will be measured incorrectly. So that's sort of crowding. Here's how crowding typically happens. There's an attractive trading opportunity developing. You can think of all the way back to long-term capital. You can think of the 2008 crisis. Copycats, so someone discovers the space. The copycats soon hear about the good returns, the good dynamics, and they start trading in the space as well. So people start flooding the space. Herding, in a sense, occurs. Okay? Now, the herding may be very hidden. Some herding is kind of obvious. The internet seemed obvious. The housing bubble seemed obvious. I shouldn't say seemed obvious because 95% of people got it wrong. But it may have seemed obvious. But some of the crowding is very hidden. Long-term capital, which I'll talk briefly about, was an example where the trading space was crowded, but it was hidden, and you really didn't understand it. And crowded spaces are different. For example, there can be one type of crowded space where everyone does the same thing. All the holders are similar, they have similar behaviors, and they're all long a certain position. You can also have a situation where there are N types of holders, 2 or 3 or 4. And they all behave very differently in the space, and this matters, especially in 2008, it mattered quite a bit. And finally, holders can have the same position or different positions, which also makes a big difference. So what I mean by that is, you can have a situation where you have a crowded trading space. An example could be the spread on the corporate spreads narrow, but there are two types of holders. One is going outright long the corporates, and one is going long corporate, short treasuries. So there are two different types of trades, but they have the same net effect to the naked eye as we look at the trade. And that makes a big difference as well. So, and I have a couple examples today that will hopefully clarify that. So that's some background. What are some examples of crowded trades that we all seen in the past? Perhaps the first well-known crowded trade was in the 1980s, portfolio insurance. And I'm sure some of you remember this. Probably it was a nightmare day for some of you, maybe a great day for others. But the idea was simple. People came up with this dynamic way to hedge options. So if you remember, for those who are, there's some students here, so pardon me when I say things of this sort, but when you hedge a put option, the idea is when the stock price goes down, you sell more of the stock, okay? So you can see that it actually is a nice idea to offer portfolio insurance and guarantees to people who own equities. But if everyone followed the strategy, it would lead to self-fulfilling prophecy where prices would continue to go down. And so that was sort of 1987, where the crowd sort of pushed prices down. They all copied the same type of trade. Another example is long-term capital. Now, long-term capital is actually discussed a lot in the book. However, today I didn't really plan to discuss it a lot, but then Richard had told me of this conference you went to and talked to Bob Merton, and he gave you a very short answer. So I'm happy to talk about it and answer questions if you have any questions. But the simple thing, what happened to long-term, people tried to claim that long-term, they were just a bunch of idiots. They over-leveraged. They thought they were smart and they weren't smart. Other people may have said, oh, they thought that you can take academia to the real market, right? Or if you're Talib, right? I'm not a fan of Talib, but if you're Talib, you just said, oh, these guys, they don't know anything, right? They've never understood anything. Well, all those things were wrong, right? That wasn't, if you know the history of long-term capital, these were experienced traders at Lehman Brothers. So saying that they didn't understand markets or they were too academic is just, it's not true. So what really happened with long-term capital is they had a good idea. And the good idea was novel in the 80s, and in the 90s it started to get crowded. Very, very crowded. It was a hidden form of crowding because so many people were doing their trades that even they really weren't aware of how many people were doing their trades. And so what was their basic idea in a nutshell? Long-term capital believed if we find a lot of complicated trades across the globe, that we can take an arbitrage position on trades that we believe will converge. In other words, one is overvalued, one is undervalued. And we take enough of them, even if some go against us, the diversification of that basket of complicated trades will lead to a very low-risk portfolio. That was their idea. And in fact, if you looked at the data, even going back 100 years, most of these trades had very little correlation. But what happened is as the copycats funneled in, what you essentially had is lots of people doing the same exact trades. And if you look at August, September 98, you'll see that even when you try to measure liquidity, so a liquidity event, that some people claim is just a liquidity event, you'll see trades that were very liquid, very illiquid being hurt, but then other trades that were liquid being hurt as well, and the only commonality was that they were owned by long-term capital. So when the copycats started selling, their trades were getting pushed against them, they were levered, and they went down. Now there's one other thing. I don't want to make it so simple, long-term's failure. That was part of it. So mismeasuring the idea that crowds in a trading space have an effect on the risk-return space. That was one of the problems. And the second problem was that I personally looked at all their trades in 98, and some of the trades weren't as beautiful as they used to be. So in the 80s and early 90s, they had really, truly beautiful trades. And what I mean by that is, you looked at these trades and said, this is genius. This is just pure arbitrage almost. There's no pure arbitrage, but close. In the late 90s, their trades started pushing to a degree where it didn't look as pretty. They were a little bit riskier. So there were two things, I think, that brought them down. So that's my simple story, but I'm happy to answer any questions as we go forward. And the book talks about every trade in detail. So it was a case of crowding. I interviewed Jimmy Kane during the book, and by the way, the guy's a fascinating individual. I know he gets a lot of bad press, but I tell you, he's fascinating. And so I said to Jimmy, I said, can you tell me this? He had to remember back. Now you should know why Jimmy might know something. Jimmy had invested in long-term capital, so it's kind of funny how the world goes in a circle, right? He was CEO of Bear Stearns in '98, and him and Vinny Matona had given about 20 to 30 million to long-term advantage. Okay, so they did know, and he played poker with John Merriweather and golf, so they were friends, right? And I said, so what happened? He said, the exit door got too crowded. That's what he said. He's a funny guy. I can't help it. Okay, the next big price, and I'm happy to answer questions on long term as we go forward, or Jimmy King. So the next big crisis was the internet bubble 2000. I think everyone knows this. I have a cute example, but I'm going to skip it in the interest of time of how bad the internet bubble was. But that was another crowding. One could argue was the same type of holder. Well, actually, there were two types of holders, but everyone was running for the internet. So we had this herd, we had a crowded space, and we saw what happened soon after that. One of the reasons probably that the internet collapse wasn't as detrimental as the housing bubble in 2008 was because leverage was so much lower. And in fact, the politicians didn't understand that either. There's an interview with Barney Frank in 2006 in the Senate committee when they're trying to limit housing exposure. I don't know if you read this transcript. And they say to Barney Frank, who of course is a classic politician, always trying to get votes and please his constituency, he says, well, this isn't like the internet. We shouldn't be worried about regulating housing because this isn't levered like the internet was. Right? So, he's retired. Anyway, so that was it. So everyone knows this, and there's some cute examples, but I'll skip. And I'm happy to talk about this one. This is a fascinating, the Palm mystery was a fascinating example of leverage in the internet bubble, and there were some good arbitrage trades. So let's forward to 2008, and I will just touch on a couple stories. 2008 had really probably the most examples of crowded trades. And as I researched this and talked to so many hedge funds and banks, I was amazed at what happened in 2008. And not just the headline things, the housing collapse and all these, sort of the behind-the-scenes events. So there were crowded spaces in 2008 almost everywhere. Okay, let me skip this story. So this is a story I was going to tell, but I think everyone knows the housing market, and we're sort of short of time. The only thing I will say about this story is I want to reemphasize, and I'm sure most of you know this and it's not new, but I want to reemphasize that the housing crowded trade was caused by everyone. It was what I call the circle of greed. It was not the banks, it wasn't Freddie and Fannie alone, it was everyone. And I think it needs to be reemphasized a lot because even Dodd-Frank, here's the irony of Dodd-Frank, whether you agree with it or not, Dodd-Frank doesn't even mention Freddie or Fannie. And some people believe they were the primary cause of the housing bubble. I'm not sure that's I think it's everyone. But it's important to remember home buyers all the way to hedge funds were responsible for the housing crowded trade. Not just, and remember home buyers who figured it out. They said if long-term does 20-to-1 leverage, why don't we do infinity to 1? And that's what home buyers did, essentially with 0 down payments. Okay. And I do want to say one last thing about the housing bubble. Realtors. At the time I lived across the street from Freddie Mac and up in Tyson's Corner, and I used to go around with realtors just to see how they would approach the housing bubble because I was convinced it was overvalued, just using a very simple model. And I had an agent from Long and Foster that used to drive me. He was a basketball fan. He was from Richmond, actually. He used to listen to all the games. I forgot what team it was, but he loved the team. And we drive, and every house we went to see, I said, there's no way the average person can afford this house. And by the way, the house looks like beep. I'd also mention that. And I would say, this house is such a shed. This should go for $15. And he used to laugh at me and say, real estate in DC never goes down. You should know that. This is a stable area. So 2 years later, after the housing bust, I got this email from him. I hadn't spoken to him in 2 or 3 years, but I got this email that says, how's California? just came across an old email and wanted to give you credit for predicting the market shedding, a total shed, and he goes on to say some other stuff. So it was kind of funny, but he was just as guilty as everyone else, telling me the real estate prices would never go down and getting his 6% commission. He was a really nice guy, though. Okay, I'm going to skip some of this. I think you guys know most of this, and it's not as interesting. So here's story 2. Story 2 is about a crowded trade that maybe you're aware of, maybe you're not. It's very related to JP Morgan's problems this year. So, JP Morgan, had this whale trader. They lost about $7 billion. Jamie Dimon isn't a superstar anymore, and blah, blah, blah. Okay, so this is a trade that occurred in 2008 by some of the major hedge funds. Very similar to what caused JP Morgan trouble. What was the trade? And by the way, John Merriweather's fund also did the trade. So long-term capital, John Merriweather formed a new company called JWMP, and that company closed in 2008. Okay, so this time under better circumstances. So here's the trade. It's a little bit complicated, so let me try to explain it as best I can. So there's these new indices called the CDX. They're based on corporate bond credit default swaps. Okay, and I'm going to sort of simplify this. But one of the indexes is the investment grade index. And what it does, it essentially, you kind of order all the top US companies, the top 125, by market capitalization, let's say, the biggest US companies, and you create an index that's equal weight all those companies. And the index is based on the cost of a credit default swap on the debt of those companies. Okay, so that's sort of the index. Okay, now let's simplify what it really means. You can buy different tranches of the index, just like you can with mortgages. And let's stick to sort of the 0 to 3 and 30 to 100. The 0 to 3 tranche is the weakest tranche, or the lowest rated tranche. And what it says is, if of the 125 largest US companies, if they start defaulting, then the 0 to 3 tranche starts losing money first. Okay, so it's the riskiest. The 30 to 100, you only start losing money. That's if you sold the insurance, right? You can buy or sell it. If, well, let's say at the minimum 30% of the US companies have to go bankrupt or have to default on their debt. But it's actually more than 30%. And the reason is, in the contracts, they specify a recovery rate. And we don't have to get into all the details. But the basic idea is the recovery rate says that if they do default, we pay you only 100 minus the recovery rate. And it's around 40%. It's specified in the contract. This is different than corporate bonds where you don't know what the recovery rate is. Here it's specified in the contract. But it's roughly, you get about 40% back. So for the 30, if you sell insurance on 3100, you need about 63% of US companies to go default on their debt. A very unlikely scenario. These are the 125 biggest, most successful companies in the US. IBM, GE, et cetera, okay? So we would call this a really unlikely event. Okay, so that's the background. Any questions about the setup? So here's what happens. I'm gonna ask you guys a question. It's 2007, December 31st, and God comes down to you and tells you all what will happen in 2008, okay? What trade would you take? You're a hedge fund, okay? So you're John Merriweather or some other hedge fund. Which trade would you take? One is buy insurance on 30 to 100 and sell insurance on 0 to 10, or sell insurance on 30 to 100 and buy 0 to 10. Okay, so someone pick 2, okay? So yeah, 2 seems the right idea, and the idea is that when the world goes to shambles, as it did in 2008, some companies are going to go under, and if we bought insurance on the first companies that go under, we get paid. And it's very unlikely that the other 63% of the US companies will go default. So we'll collect money by selling insurance on that. So even if we knew what would happen, we think that's a good trade. A lot of these hedge funds, including Merriweather's hedge fund, Park Central, who managed the money for Ross Perot, these hedge funds had trade 2 on. So you think smart. But here's what happened in 2008. This graph basically shows you the cost of the 3100 insurance over the 0 to 10. So the bigger the shaded area gets, the more expensive 30 to 100 is. Or another way of saying that, the more trade 2 is losing money as it goes up. Right after Bear Stearns collapse in March '08, this thing shoots up to where the 30 to 100 was 150% more expensive than the 0 to 10. So essentially, if you had that trade on and you were levered, you lost a tremendous amount of money. Now, why did it happen? It happened because the holders of this trade were very different, and they behaved very different. And so when the market started trembling, people were selling. One type of holder was selling regardless of valuation. And the hedge funds kept their position, but were losing a fortune until they got margin calls, and then they had to cut the position too. And what was their mistake is the hedge fund's mistake was not understanding who owned the position and what they would behave like if something sort of happened, if there were rumors out there or the market went down. I'm going to do another one that's similar, and this one is another crowded trade that fell apart. So again, it's December 31st, 2007. You have the choice to buy A-rated debt and short AAA rated debt, or the reverse, short A-rated and buy AAA. So what would you do? You know what's going to happen in 08. Two again, okay, two again. The idea is, everyone knows this. It's almost like we were born knowing this. If you're in finance, you were born knowing this. In a financial crisis, spreads widen, right? It's just a natural thing. Riskier things have to give you a higher return on average to compensate you. So we all know this. We were born knowing this. Well, some of us. So what happened in 2008? A lot of these companies did it. And one of the hedge funds lost 39% unlevered in September 08 through November. November losses were 26%. Now, this is why it's kind of so, you can imagine the hedge fund. They get through at September, and I talked to a lot of these hedge funds, and they told us, we got through Lehman Brothers, and we were there going, we made it. Wow, we survived. And then they went bankrupt in November. So they got a double whammy. One, the trade made a lot of sense, and it failed tremendously in November. And two, they thought they made it, because they got through Lehman Brothers. And one of the hedge funds, they were the only one who wouldn't talk to me. And I can't mention names here, because I feel bad for these people. Now, one of them is a big guy at the place you might invest in. But you know what they did? They doubled down at the end of October. They thought we made it through Lehman, and they doubled their leverage. And they went bankrupt. In fact, they're in court because people still need money. That was a funny story because it shows you that when people lose money, they don't like to cooperate. So I had a connection that got me his phone number, that CIO. And I called him several times, and he never returned my call. Finally, one day, his secretary put me on the phone with him. And I said to him, look, I'm a friend with these guys, and I've treated them very well. I'm being very fair to people who I'm interviewing for the book. So I'm not here to make you look bad. I just want to know, this number. I needed a number for November. And he goes, if you were my fucking friend, you wouldn't be calling. So, sorry about the language. That's what happened. Okay, so why did it happen? Post-behavior, Lehman was chaotic. And I don't know if we'll have time for that story, but Lehman Brothers, allowing Lehman to fail really caused some very specific, again, unwinding of crowded trades to cause chaos. So that was one reason the trade didn't work. The other reason the trade didn't work, and JP Morgan learned this year, is that it was built off this thing called the CMBX, the Commercial Mortgage-Backed Index, which again is one of these newly created derivative securities based on commercial real estate. So what did the hedge funds do incorrectly? The first is their hedges were wrong. And without getting into technical details, the hedges were right. If you and I sat down and looked at their hedges before things happened, you would have said that's the right hedge. But it just turned out it's supposed to be the wrong hedge. Because of the crowding and the holders disappearing, they measured risk incorrectly. Second thing happens is that they have short history. And it's true to this day, by the way. All these indices have about 5 years. They started in the 2000s. So they don't have much history. And one of the things I'm amazed at, and I could be wrong, but one of the things I was amazed at watching all these trades is how hedge funds and banks will take these massive positions on data that has 3 or 4 years of history. And sure, it's true that the CMBX is supposed to be perfectly correlated with AAA and single A. yields, okay, so the inverse, right? But it's still a new instrument, and you don't know who holds it. Whereas we know with A's and AAA's, the actual bonds, who's been buying these for years, right? This has been 30, 100 years of this. Whereas here, this is a new instrument, and we don't know who holds it. And 3 years of historical simulation won't really tell us the risk of these trades. And that was another, in my opinion, shortcoming of both JP Morgan and these hedge funds. So that was another problem. And what it turned out is the holders were very strange. The AAA part of this bet was held by levered risk-averse institutions. One of the biggest holders was Canadian commercial banks. What they did is they saw these CMBXs that were rated AAA, and they said this is a great way to get leverage and increase our net income. So what they would do is they would buy these AAA CMBXs and lever them 30 to 1. These are commercial banks. So they were more levered than some of the hedge funds. And what happened is they thought it was a free lunch. It looks good on our balance sheet. Basel II has told us these AAA things get very low risk weightings, so we can hold them, no one will complain, and we'll get this extra kick. When the crisis started in 2007, 2008, and we started to see mortgages go down, the first people to run for the doors were these guys, because they couldn't afford. You can imagine you're the CEO of a big commercial bank. You can't afford to have that in the headlines that you were 30 times levered on these AAA CMBXs. So they sold them. And what happened is the hedge funds held them. So even though it didn't make sense that this was rallying, the risky stuff was rallying, and the expensive stuff was dropping, the safer stuff was dropping, it didn't matter, because as this particular holder in the crowd ran for the exits, the only thing that mattered was in immediate supply and demand. Relative valuation was in the trash can. And so it didn't matter. And if you were the hedge fund that had the logical trade on, you were losing tremendous amount of money. You got margin calls, which made you sell more, exacerbate the problem. And on top of that, the hedge funds that wanted to get in the game and try to, so the arbitrageurs to bring it back, they couldn't. There was not enough capital to do so. There weren't enough hedge funds to come in and do it, because these were major banks selling this stuff. Now, what could they have done differently? It's hard to say, because hindsight's, it's easy to criticize people. I would say the only thing is, again, people really have to be mindful of the crowd and the space. So when they saw these CMBX spreads closing over the last few years, they should have asked themselves, why is it closing? And I think in the book, I have a quote from one hedge fund manager that I interviewed. The guy managed the Ross Perot money. It was only Ross Perot. It's Ross Perot and a lot of other people. And he said, in retrospect, we should have asked ourselves why these instruments were doing so well leading up to 2008. And we didn't. And if they'd done that, they may have learned that there were some commercial banks that were levered on the AAA. And JP Morgan did a very similar thing. Now, JP Morgan added some other things, lying and cheating. Okay? But they had this also. Okay? But then they added lying and cheating. Okay. The other thing was, I asked some of these hedge funds, well, why didn't you just sell it? So now you have this spread trade that we thought was great, but it's losing. Why not sell it? And they said we couldn't. When we tried to go sell it, again, it goes back to this crowded space, everyone exiting, supply and demand is the only thing that rules. Valuation's out. So you go to sell something that no one wants, well, the price is probably zero, or at least very low. And so their calculation was, it doesn't make sense to cut a position that the minute we cut it, we lose 20% immediately. So they held on, and now, what's the funny thing? I should say the other part of all this that I sort of forget to say, all these trades, a year later, make a fortune. So if you could hold these trades another year, you made a fortune. And this trade in particular made a fortune 1 year later, but unfortunately most people had closed their books. This hedge fund, one of these hedge funds in particular on this trade, lost so much, because remember, 26% unlevered. They were levered about 8 to 1. So they're still in court with all kinds of lawsuits about who gets what, and we'll see what happens in the end. This is from the JP Morgan internal report. Has anyone read that? I wouldn't bother reading it. It doesn't say anything useful. So JP Morgan did an internal report that doesn't give you any really useful information. It kind of is the standard, high-level report that says, oh, we did this, we did that, we kind of hedged, we kind of did. So, but it was related to, again, the synthetic credit. That's the only thing that was consistent. Okay, so Here's the thing. Time is, I don't know how we are on time, but I have 3 more stories. We can't do all 3. We could probably do 1. So let me try to get a hand on, and then we have Q&A. So one story is about why Lehman Brothers failure was so bad for the markets. That's one. And there's lots of reasons. This is one of them. So I'm not going to focus on all. This is one strange one that a lot of people haven't focused on. The second story is about the quant crisis of 2007 that might have been a sort of an indicator of what was to come in 2008, but we all ignored it. And the last story is the flash crash. That's not so exciting. I kind of biased that first story. Any takers? Lehman? Is it Lehman?
Yeah.
Okay. Okay, I'll thank you. I'll try to. Let's go to Lehman first. So, quant crisis, it might be exciting. I know a lot of you are equity managers. Okay, so Lehman. Okay. So we start Lehman by saying it's 2008 again, December 31st, 2008, and someone comes to you and tells you what's going to happen in 2008, and it's December 31st, 2007, and you're running a hedge fund. And so which trade do you do? So one trade is go long the 30-year swap rate. So I should specify what that is. So swap yields over treasuries, the spread. If you're long the swap spread, you want the spread to widen. If you're short the swap spread, you want it to narrow. Okay? So which trade would you do? And this is at the 30-year area, 30-year maturity area. Which one would you do if you knew what was going to happen in 08? One. Right? And I'll tell you I did this, so if you go back and look at the history of the United States and even other countries, every crisis the swap spread widens. Every crisis. You go back to long-term capital, the Asian crisis, swap spreads widen. And it's a natural phenomenon. When risk gets higher in a country, the first thing to go are the riskier things. And swaps are based on interbank lending. That's riskier than US Treasuries. So it widens. It's a natural thing to happen. So now here's the funny thing though. John Merriweather, Myron Scholes. Myron Scholes was running a hedge fund too called Pagam. So this was the other half of the long-term guys in another hedge fund. All these hedge funds, and there's more. There's about 50 hedge funds in this group. They all had, not all of them, but a lot of them had this trade-off, number one. So they didn't know what would happen in 08, but yet they got it right. We know what happened in 08, and we think that's what we would do, okay? So that's what's interesting. But guess what? It didn't work. So here's 08. Focus on the black line. This is the Lehman bankruptcy. This is the 30-year swap spread. It averaged around the last 10 years about 50 basis points is about the 30-year swap spread, okay? After Lehman collapses, gradually it goes negative. So basically, not only did it shrink, it inverted. So for a long period, US government was seen as riskier than banks. Okay? Now, it would have been hard to predict that, okay? So it was irrational again. So here's a story of why it might have happened, okay? And it has to do with holders, it has to do with crowding. So, I want to say one thing about the reason I have that quote up there is because I personally looked at Lehman Brothers for a long time, and I wasn't convinced they should have gone bankrupt. This is just my reading of all the data, okay? And they did, though. And it's hard to distinguish whether it was a run or not a run. Bear Stearns was probably a run. But Lehman, it's unsure, but I think they may have been solvent. And this is Jamie Dimon 2 years later. When they interviewed him in the Congress, they asked him, was Lehman solvent? He said, what does solvency mean? The answer is, I don't know. I still couldn't answer that question. It's interesting, right? So this is supported the guru of banking, and he wouldn't have been able to answer. Just a little side note. So let's go back to the Lehman debacle. So typically swaps trade over governments for what we just described. They're risky. After Lehman, what happened is different holders of different instruments behaved very different as the crowd exited the space. And again, if you didn't model this or think about it, and you would have been in terrible risk situation. So here's what happened. I have to do some history here. Pension funds typically receive 30-year fixed. So if I'm a pension fund, I do lots of things, right? I buy equities, I do lots of things. But one of the things I might do is receive 30-year fixed on a swap. We don't have a chalkboard, otherwise I'd draw all this. But you receive 30-year fixed, why? you typically have long duration liabilities. You're a pension fund, you're going to have to pay people's retirement. So you have long duration liabilities. That's an exposure. How do you hedge something that's long the interest rates? You short interest rates. One way to do that is to receive 30-year fixed on a swap. You could also, by the way, short some kind of bonds, but this is a cheaper and more effective mechanism. Hedge funds are in a different business. Hedge funds are typically paying 30-year fixed. Again, this is not every hedge fund. It varies, but this is on average. And why do they do that? They typically have other exposures. They may have bought a cheap bond, for example, like long-term used to do. They buy a very cheap bond, but they don't want interest rate exposure, so they need to hedge that out with a swap. Okay? So Lehman was the intermediary for this. They were just the middleman. Okay? Here's a picture of what Lehman did. And I'm exaggerating. We know that Lehman also bought all the real estate in the world. Okay? Let's forget that part. Okay? They did, their portfolio was about 28% real estate, shame on them. But this is the other part of the business. So pension fund wants to receive fixed on a interest rate swap, pay floating, and the hedge fund wants to pay fixed and receive floating. So Lehman just steps in the middle, and Lehman passes through all the payments. So Lehman, in theory, of course they did actually take some risk, but in theory they have no risk, right? They're just a middleman, okay? This is great, except when Lehman was allowed to go bankrupt, the ISDA, which is the International Swap Dealers Association, had a clause that I don't think Bernanke was aware of, Paulson, or any of these guys, which said that if you go bankrupt, you can send a fax that night to terminate your swap position, okay? And here's where the problem started to occur. So what do? No one wanted to keep a Lehman swap. There's no upside. Lehman's going to go into bankruptcy court. If you're winning on the swap, you'll never see your money, or maybe years. And if you're losing on the swap, you'll have to pay, and you never had any upside anyway. So you want to get out of it. There's no gain to being with Lehman Brothers. So pension funds and hedge funds are going to cancel their swaps. So everyone's sending the fax. The problem, though, is a pension fund has a real liability. So if they cancel the swap with Lehman, they have to reestablish it with another company because they really do have a liability. So pension fund cancels with Lehman and runs to the market for a new swap. Okay? So demand for that fixed swap. The hedge funds have a different game. They also want to cancel the swap, but they have no reason to reinitiate it. And there's lots of reasons why not. One, the world is now collapsing, okay, in people's eyes at least. So when the world's collapsing, we all know, Fed reacts, interest rates go down. So you don't want to be paying fixed interest rates when the world's collapsing. So you're not going to reinitiate your pay fixed swap. You will not do it as a hedge fund. Okay? Second thing is, hedge funds are having margin calls. So they're having to cut their book. So even their arbitrage trade, that cheap bond they own, and they hedge with swap, they're having to cut that position. So as they cut those bonds, they don't even need the new swaps. So they can roll down the book. So two reasons why hedge funds don't want to do it, but pension funds have to. Okay? So here you've got it. You don't need to see anything else. You've got an amazing supply-demand imbalance. The holders of the securities are different people, different institutions. They have different needs. And when Lehman goes bankrupt, there's a massive demand for fixed-rate paying swaps, and there's no supply. I mean, there is supply, but it's low. And so what happens? You get the swap spread invert. Everyone wants those 30-year swaps, but no one's going to supply them, so the price has to go up. And it went so far up that it became negative. It became cheaper than Treasury securities. Now, what's sad about this, if you were one of these hedge funds that thought, oh, I'm logical, I'm, John Merriweather, for example, other hedge funds that did this, Triple I in Florida, if you're one of these hedge funds, you had a great trade on them, but you're losing your shirt. And you can't explain it except for that you mismeasured the crowds. It happened in other countries too. Remember Lehman was a world global bond intermediator. So it happened in the US. Spreads went from 50 on average to negative. In UK from 49 on average to negative 29. Japan from 7 to negative 25, and even in Germany went negative. So all these countries had sort of a spill-off effect of the Lehman bankruptcy event. And the crowd was trying to go out of the trade. Okay, so that was that. And these hedge funds lost a lot of money. One of the hedge funds I interviewed, in the book there's some quotes from John Merriweather of how he saw what happened. Okay, I mean it's very hard though. What do you say to your investors? Right? It's like, well, we had the right idea, but it didn't work. And remember, these are staple trades. So the way one hedge fund described it, this was with a hedge fund of Byron Scholl's, Chifu Wayne, who's also the co-head, and he was at long term. He described it like this: we really got hurt on this trade because this trade was not only a trade that lost money, it was what we consider a hedge trade. Meaning, this is a trade we put on that when things get bad, it does well. So if your other trades are hurting, this kind of buffers you. Well, it didn't this time, okay? And another person that I interviewed in the book, and I've quoted him there, I will try to paraphrase. He was at III, he was the CEO of III hedge fund. They survived, but they really suffered. And he said, it's crazy, you know, not in the history of these markets have we ever seen this happen. And what's even crazier, had we done that same trade on 1 year swap spreads, we would have had the best year of our entire existence. He goes, but that's not the way you're supposed to think about it, you know. So anyway, it's fascinating, it's sad. So what happened to John Merriweather, so you know the outcome of this. So both John Merriweather's fund closed in 09, early 09. I think you're probably aware of that. And so that's it. That's kind of the end of the LTCM legacy as I see it. And then Scholl's fund did not close, they stayed open, but they were down like 50%. And so they passed it to the younger generation to manage. So Scholl's doesn't run that fund, and neither does Chief Wayne. But they're out. Park Central went bankrupt. And some of the others went bankrupt. A lot of hedge funds just went bankrupt. So those were those stories. Do you want to do one more? Or Q&A? I don't know what's the best right now. Okay.
What asset classes are RSCC
It's interesting. The truth is I don't know, but I'll show you what I think. But I'm right now trying to research this with some other people to figure out ways to detect it. So until that's done, or if we can do it, we might not be able to do it. I really don't know, but I'll give you some guesses that you probably have already guessed yourself. And you're welcome to disagree with this. I have a couple of guesses here. So here's some that might be overcrowded in different ways, right? But maybe chips are overcrowded, treasury securities overcrowded, gold's already come down, and maybe junk bonds. But I don't want to put a lot of. I didn't run a model to do that, so. But they might be crowded spaces. Yeah.
You flashed something that said Apple at 100,000. Could you go back to that and explain it?
Okay, that's another story. But we can do it. You want to do it? Okay, let's go back. I'll try to make it not too long. This is a fascinating story, and this is after the financial crisis. So story 5 is the flash crash of 2010. Is that good enough?
Yeah.
So do you want me to do it? Or?
Yeah. Did Apple trade at 100,000?
Yeah, 100,000 share.
During that day?
Yeah. Hopefully you didn't buy it.
Yeah.
I mean, Steve Jobs was very charming, but not that charming.
Okay.
Okay, I'll tell the story. So this is one day, May 6, 2010. Apple trades at 100,000. And so how is it related to crowding? I'm going to try to explain that. It's a little stretch, but I believe it is that an Accenture traded at 1 penny. People really did buy these. So this isn't fictitious. It happened. People unfortunately did this. Here's a picture. Where's my picture? It's not as nice as it should be. Okay, some reason it's not coming out very nice. But this is the picture of Apple. And you can see this is the trading day. Apple for most of the day is pretty tranquil. This starts at 9:30 a.m. That's at 4 p.m. And then suddenly Apple dips big time. And then around 3 o'clock it goes to 100,000 a share. So, and there were many trades of that. And there were other stocks that had similar debacles. So what happened? So a lot of you probably read the newspaper and remember the Waddell Reed excuse, okay? So the Securities Exchange Commission did a study, two reports, and they said that Waddell Reed caused it. And just as a refresher, remember Waddell Reed is a mutual fund complex, I believe in Chicago, and they had an order to trade 75,000 E-mini S&P futures, okay? And the report by the SEC claimed that this was such a big trade, it caused a glut in the system and things failed, okay? This isn't the right story, okay? The SEC rushed to do their report. They wanted to find a quick explanation so that markets would be happy. And it is true that there was this trade, but this trade was it's a trade that's happened many times in the past, and it wasn't that big. And the problems occurred much later. So it's highly doubtful this trade caused the flash crash. But that's their story. Now, I will tell you, I interviewed the SEC. I wrote to Mary Shapiro, who then forwarded me to the chief economist. And I talked to them because one of the things I discovered in my research is that they claimed in their report that the problem with the Waddell Reed trade was that Barclays executed it. They did a trade without, all equity managers here, I'm sure you're familiar with this. When you trade a big amount, you try to have sort of a trading rule so you don't have too much market impact. So there's VWAP, there's all kinds of rules, right? The SEC report claimed that they sent in the trade without putting some kind of rule. So that it kind of sell at all costs 75,000 shares regardless of price. Okay? And they claimed that this was a silly maneuver, very childish, amateurish. But the problem is it's not true. And here's what's so sad. The SEC never interviewed the Barclays trader who made the trade. But they said what he did. And I find that funny. Now, afterwards that they published the two reports, they did go interview him, and then it was confirmed that they were wrong about that. So that's one of the questions I asked the SEC economists, one of the chief economists. I said, just please tell me this. Is it true that you said this in your report, but you never interviewed him, so you really didn't know? I can't really talk about that. What I can say today, this is after an hour of conversation where I'm still trying to get information. What I can say is that there is nothing inconsistent in what you've said today. I don't know what to do anymore. So that's what happened. So what did happen? Here's what happened. It's a really simple story. And I will credit the SEC with one thing. They do mention this in the report, they just don't highlight it. The NYSE ARCA, the electronic exchange system for the NYSE, basically had old computers on many of their stocks. So they were in the process of upgrading the computers. Half of them had been upgraded, half had not. And what happened that day, it's still unsure exactly why there was so much fast trading. Some people think it was high-frequency traders. Some people think there's no real accurate story yet. But due to this fast trading, the old computers couldn't process fast enough. So what happened is, on the tickers that went to the old computers, they would release them to the consolidated tape with a delay. And again, so what's consolidated tape? In the US, we have this beautiful system where all trades that are made in the US are posted to a tape that we can all read. And why is that important? Because of transparency. And what happened is, because the computers at ARCA were slow, they would post to the tape late. So you would see prices from other exchanges at one number, and the NYSE ARCA prices at a different number. And let's look at what that might have done. One thing that might have done, if you're a market maker, you get scared, right? You're scared. Because market makers are there to buy and sell at a bid and ask, and they take risks. And if you see inconsistencies, you might think, wow, this isn't the day to be doing this, right? That's what you might think. So here's an example of the inconsistency. This is from the actual consolidated tape. This is 2:47 and 25 seconds. Same time, same second. And these are the prices of Accenture. Now, right, it's a big difference. This is the US, this isn't sort of a new developed market, right? The price of Accenture can't be 38.66 and 40.22 at the same second. Not in the US, right? That's not unheard of. And then also to bounce back so quickly. So if you see this, I mean, I really, who knows what we would have done if we were market makers. But one reaction of a market maker may be, I need to get out of here. It's too risky, okay? So, but the US has a law. And what's the law? The US has a law that to be a market maker, you have to always quote a bid and ask. And that makes sense. Why? Because otherwise, well, I don't know, I shouldn't put you in this, but I might. Just quote when times are good and go on vacation when times are bad, right? So the rule is a good rule because it forces you, if you're a market maker, to always give bid and ask and provide liquidity. But here's the irony, it doesn't work. Because market makers are smart, and what they figured out is when things get troublesome, we will put in what are called stub quotes. Stub quotes means I will give you a bid and ask because you told me I have to by regulation, but I'm going to make it so wide it doesn't matter. And it turns out most systems default to 100,000 and 1 penny. So you're still quoting, but it's not useful for anyone. Now, what was interesting, here's where the crowd comes in. All these market makers on these stocks got scared. Everyone ran for the exits. So the only thing that was left on these stocks was the subs quotes. And there happened to be a major broker-dealer who I never identified. I tried my hardest to find out who it was. I couldn't, the SEC wouldn't, they know, but they wouldn't tell me. But anyway, they were sending a lot of trades through the system, and they were just hitting the sub quotes. So if you needed to buy at that time, you bought for 100,000, any of those stocks. If you had to sell in that time, you sold at 1 penny. And that was just the way it was because there were no market makers. Why it's so devastating is because we're talking about the US markets, the most liquid probably in the world, other than the currency markets maybe, and yet liquidity completely vanished when it was needed the most. For about 30 minutes, it was gone. Every market maker ran for the exit. There wasn't, the whole point of it, right, is that we think someone will step in and say, I will buy and make money off this opportunity, but no one did. And so that was one of the sad things. Now, liquidity did come back about 40 minutes later, something like that. It all came back. Again, that's a puzzle. I talked to some experts that do this for a living, because I'm really an amateur in this area. And what they told me is there was a particular time, and I can't remember it, it's in the book, that they believe is what caused it. And it was some activity by some HFTs that started causing the glut in the computer systems. But the SEC doesn't want to investigate it. Again, I called the SEC, I'm going to tell you what they said. And I said, well, why don't you investigate it? Because your report is incorrect. So don't you have time to go figure this out? I can tell you the time it happened. And they said, this was it. I don't want to do these funny voices, but we don't have time to investigate everyone's claim about when things happen. So that one I can understand. Okay, so I shouldn't be that harsh. But these were experts. So that was the flash crash. So that's 100,000. Oh, now what did happen? Is that what you're going to ask? What happened?
I was just saying, did anybody actually buy and sell them at that point?
Yeah, they did. So now here's a question for you. Well, I'm going to answer it, but this is an interesting question. Suppose you're the regulator, you're FINRA. What do you do after this? It's 2 days later. You know a mess up happened. What do you do? So people did buy Apple at 100,000. People did sell Accenture at 1 penny. What do you do? I'll tell you what they did. What? Just cancel them?
Reverse.
Yeah, that might have been right. Maybe that was the smartest thing. Maybe you should write a letter to FINRA. But they did something weird, and I don't want to judge this because but I thought it was weird. They decided that any trade that traded 60% above or below when the market was stable, those were canceled. But anything in between stayed. Which I don't necessarily think is the right thing because you still could have bought Apple at 60% premium and you had to keep it. So it doesn't seem the right thing, but that's what they chose to do. And it was arbitrary. They just met in a room and decided to do that. Any questions? I guess we're in Q&A. Yeah, let's go.
With these trades, what's the interaction with mark-to-market accounting and any other thoughts with that?
That's a great question. I talk about it a little bit in the book. It's a really difficult issue. So I don't want to say I know, and I don't think anyone knows, but maybe someone doesn't. If you know someone has a good answer, send me an email. It's definitely relevant. So here's one of the tough things to ask ourselves, I think, and I don't think there's an answer. Some people say, of course, mark-to-market accounting is great. Let's do the housing. Housing's really easy, like Freddie and Fannie. Mark-to-market accounting is good because it tells you a live snapshot of what the true value of your positions are today. So that's the most transparent. But others could argue that there are certain assets that are long-term assets that even though the mark-to-market would say you're bankrupt, any kind of reasonable cash flow calculation would tell you you're going to be fine in 5 years, right? Take a mortgage, right? As long as even with a high default rate, you could estimate the cash flows here are going to be much better than where they are at the bottom of 2008. So it's, mark to market, you're worth 50% less, but if you look at the cash flows, you might be worth just 20% less. So I'd say that that's really, in my opinion, that's the big issue. Which is the right thing to look at? And I don't think it's an easy answer, but I do think there's a lot of merit to looking at cash flows, at least to evaluate solvency and things of that sort. That's my 2 cents. But if you have anything on that, please email it to me, because because it's an interesting debate, what to do in that. Do you have an opinion on it?
I asked the question because the JP Morgan trade kind of felt like if they could just hold it, that 60% of U.S. corporations weren't going to go in default, and they'd be all right.
You're right, but the market, we don't have that market. The market doesn't work that way. The hedge funds, you can tell them I have a logical trade on, right? By the way, ironically enough, a lot of these hedge funds, guess who their counterparty was, who their broker was? JP Morgan. It's kind of ironic, right? But JP Morgan is ruthless in this. If you've read anything about JP, right? They are like one of the most ruthless margin collectors in the world. If you're in trouble, they think you owe them 5 times what you used to owe them. Just read any story of JP Morgan's counterparties. They did it in 08. I'm not saying they're wrong, but they do that. So it's our system, and I don't know what you do. So maybe you should start a company called the cash flow consideration. I don't know, but it's really the question of what do you do when a counterparty has a position that they say on paper looks very logical, but your systems say, well, the market value right now, if you sold it, it's not, and you owe us, 30%. So, and JP Morgan in this crisis said you owe us 30%, and they also sometimes doubled it. So they did it with Amaret. You've seen lots of it yet.
Market's always been irrational, and there's always been a herd mentality. How much willing do you put on leverage? If you're forced to sell and you have leverage, then it's a real culprit of maybe the worst case scenarios.
I told, what's your name?
Brian.
Brian, I totally agree with you. One thing that I say in the book, and I'm just getting to lessons from the crisis, here they are, but I agree with you in the sense that leverage, if you take away leverage, almost every problem we're talking about is gone. Pretty much every problem we talk about is gone. Now, I'll tell you something that's fascinating. The Merriweather guys, the LTCM guys, the Scholes, all these hedge fund guys, after the second crisis, what they said is, we think this trading style is good, but we think that maybe it's just not meant to be leveraged. And that's pretty amazing coming from them, right? So they think that the future of these trading strategies, these relative value fixed income trades, is to have a portfolio of bonds, maybe it's a bond portfolio, and you overlay it with the relative value trades, but unlevered. And that way you can hold it till it converges. And you won't get as much. Alpha will be maybe, 20 basis points maybe? But if you already have a fixed income portfolio, you don't care, because it's this plus 20. So that's what they said. So, and I agree with you. So this whole crisis is gone without leverage. Remember, the biggest leverage was housing. Infinity to 1. You take out leverage, the internet bubble. People forget this. It's funny. Most people forget that the NASDAQ in the internet bubble went down 82%. 82% in 1 year. And we think what happened in 08 was so bad. And the key difference, though, if you really think about it, participation was greater in 08. Everyone was involved, and leverage was much greater. That was the real difference. So I'm with you. I think you take away leverage. Now, there's a trade-off, though. If you take away leverage, I talk about that in the book as well, and I don't think economists have researched enough. Is leverage important for an economy to grow fast? And I don't know the answer, and I don't think anyone really has a good answer on that. But that's the only argument, I think, for leverage. Otherwise, if you want to avoid all crises, make leverage 0. But then you also may have less growth, and I don't know that, but that's the trade-off. Yeah?
With long-term capital management, had Lehman Brothers not closed their group and had Russia not defaulted on the loans, do you think they would have still had to close in 1998? Was it just the kicker, or was it inevitable anyway, or do you think that had those things not happened, would they still be?
Yeah, well, it's hard. These what-ifs are very difficult. My gut is that it wouldn't have happened then, but it may have happened sometime. Just what mattered is when the copycats, there were too many, and the space was too crowded. If an event occurred that allowed people to start unwinding, it probably would have caught them in the future. So that's my gut, but who knows? Yeah.
Can I ask about what do you think of Federal Reserve involvement in the current market, especially as far as purchasing of MBS securities on a monthly basis?
Wow, these are the questions that no one knows the answer to. It's tough, and so I'll be very frank with you. I've thought about this, and I want to get more involved in it. And so I'm going to give you a kind of not a very good answer, because I haven't read anywhere someone who's really explained it well, and I kind of want to look at it myself, but I've been very busy lately. I mean, it's what you already know. The big question that everyone cares about is, we know they're keeping mortgage rates low, and it's helping us smooth over this difficult time. We all know that. And the worry is that something's got to give. Either it's massive inflation, or when they unwind these positions, we're going to get a massive collapse in interest rates, and we'll have such a huge collapse. And the reason, so we all know that, and I just can't say with any, sincerity what I think will happen, because I haven't seen anything written very well on it, even from experts in this area. So I don't have a strong opinion, and I want to look into it. I think it's extremely important. If you have anything, please send it to me. But the Fed claim, Bernanke claims, and you can conceptually see this. He claims that when they need to lower this balance sheet, they can do it. They can just go sell it. But if they go sell all those mortgages, prices are going to move pretty fast, and interest rates go up, and we'll have another recession. So, sorry, I can't give you a better answer. I just don't have a good answer on that. Yeah.
One question: where do you get your book?
Oh, you can buy it. You can go to my website. You can buy it on Amazon. You can buy it on Barnes & Noble, any major online retailer. And if you have any questions, just email me.
Thanks.
Nope.
You will be able to stay around.
Yeah, I'm going to stay around.
But I know sometimes we need to get back to the office. So at this point, I'd like to say,